welcome you. So just jump right in. The trading world, especially when you're looking at crypto, it can feel like just way too much information, right? Like you're constantly swimming in it.
Oh, absolutely. Information overload is a real thing.
Totally. So today we're going to really focus on just two fundamental risk control rules. And what's kind of fascinating is that both traders who, tend to struggle and the really profitable pros, they often know these rules. The difference, the real magic, is in how they actually use them.
Exactly. It's not some hidden secret. These are pretty well-known ideas. But the way they're applied, it leads to vastly different outcomes. It can be a real, aha moment when you see that difference clearly.
Right. So our mission for this deep dive is simple. We're going to break down these two rules, show the stark contrast between how losing traders and pros handle them, and then give you a practical, 5-point checklist to use before every single trade.
Think of it as a shortcut to getting the crucial stuff right without getting totally bogged down.
Exactly. Okay, let's dive into rule number 1. Assume that you are wrong when you put on a trade and you reduce or remove your position unless the market action confirms your initial analysis and moves in your intended direction. Quite a mouthful, but powerful.
It really is. And the core idea is acknowledging uncertainty from the get-go. No trade is a sure thing, right?
Right.
So this rule forces you into a defensive posture immediately. You're not just hoping, you're preparing for the possibility you're wrong.
Acting defensively from the start.
Okay.
So, how does someone who tends to lose money, how do they typically handle this? Or maybe more accurately, how do they often fail to handle it?
Yeah, well, a very common trap for losing traders is they just ignore it. They jump in, maybe on a hunch. When it goes south, they just, hope. They hang on.
Hope is not a strategy, right?
Definitely not. And what's really damaging is how they might misuse something like dollar cost averaging here.
Okay, yeah, let's unpack that, because dollar cost averaging is sensible to a lot of people.
It can be for long-term investing in solid assets. But a losing trader often uses it to, double down on a bad trade. The price drops, and instead of seeing a warning, their greed kind of takes over.
They see it as a discount, a bigger opportunity.
Exactly. They think, oh, it's cheaper now, I'll buy more.
Yeah.
So they're actually increasing their risk on a trade that's already proving them wrong.
Wow. So instead of cutting losses, they're actually magnifying them.
Precisely. It's a direct violation of rule #1, and often it's driven by, ego, not wanting to admit they were wrong, and just the raw fear of actually taking that loss. So they get stuck.
Letting losses grow too big. Yeah, I can see how that spirals.
It really can. It eats up capital fast.
Okay, so let's flip the script. How does a professional trader approach rule #1? Their mindset's got to be totally different.
Completely different. For pros, it's all about protecting capital. That's job number 1. So when they put on a trade, they know the risk is real. If it immediately starts going against them, they are out. Quickly. No hesitation, no hoping. They sell out of the position quickly. They take action.
That feels so counterintuitive at first. You put money in expecting to win, not planning your exit if you lose immediately.
I know, but that's the crucial difference. Pros actively manage risk before the trade even fully plays out. They use tools like stop-loss orders.
Okay.
Think of a stop-loss like an insurance policy. You set a price, and if the market hits it, boom, you're out. They see that potential small loss as an insurance fee, a cost of doing business to protect the bulk of their capital.
So they're controlling what they can control, their own position size and exit point.
Exactly. They're not trying to predict the unpredictable market. They're just stopping its effect on their equity by removing their position if it goes wrong. Like one source says, managing risk is our only job. Preserve capital, live to trade another day.
Makes total sense. Okay, so rule #1. Assume you're wrong, cut losses quickly unless proven right. Now, rule #2. When your trade is correct, you must be bigger at that time. This feels like the exciting part.
It is. This is the flip side. Rule #1 protects. Rule #2 aims to grow. It's about maximizing profit when you are right. But notice the key word, correctly.
Right, correctly, not just randomly throwing more money in.
Exactly. It implies a plan, a strategy for adding to a winning position, not just getting greedy impulsively.
Got it. So how do the losing traders mess this one up, if they even get a winning trade, that is?
Well, yeah, if they get one going their way, The most common mistake is fear again, but a different kind. It's the fear of losing his profits.
So they get a little bit ahead and they panic.
Yeah, they panic and quickly cash out the position too soon. They grab that small win because they're so relieved not to be losing or scared it'll reverse. They just snatch defeat from the jaws of victory, essentially.
It's hatching the small win, missing the big potential move.
Exactly. They often don't have any plan for what to do if a trade does work. Their focus is just on not losing or getting that initial small gain, rather than thinking about how to really capitalize when the market confirms their idea.
It's like that bird in the hand thing. But maybe there are 10 birds in the bush, you know?
That's a great way to put it. They leave a lot of potential profit on the table because they lack a strategy for pressing winners.
Okay, so how do the pros do it? How do they correctly press winners, according to rule #2?
Well, psychologically, it's different. When a pro sees a trade working, confirming their analysis, they actually feel strategically greedy, not reckless, but motivated to maximize. They look for specific opportunities to buy even more, to have a larger position.
So adding risk, but only after the market has given them positive feedback.
Precisely. And it's not random. The sources mention things like a 3-2-1 strategy.
Yeah.
Maybe start with a smaller exploratory size. Then, if it moves favorably and hits certain criteria.
Breaking a resistance level or something.
Exactly. Or confirming a pattern. Then you add a second chunk, then maybe a third if the trend really establishes itself. It's a qualified plan tied to your specific time frame and strategy. Very methodical.
Much more structured than just buying more because it feels good.
Absolutely. The pros understand that, most of your money from trading is going to come from trades that take off rather quickly, those strong trends. So they have a plan in place beforehand to add to those trades and really ride them, letting winners run, but in a controlled way.
Okay, so rule #1 is defense, cutting losses. Rule #2 is offense, maximizing gains when you're right. How do they work together?
They're totally intertwined, like two sides of the same coin. Rule #1 is your shield. It keeps you in the game by preventing those catastrophic losses. It makes sure the inevitable losing trades are just small paper cuts, not fatal wounds.
Right.
Then, rule #2 is your sword. When you do identify a winning opportunity, it allows you to strike effectively and capture significant gains. Those bigger wins are what ultimately offset the small losses and lead to overall profitability.
So you need both. You can't just be good at cutting losses, and you can't just hope for big winners without managing risk.
Exactly. Consistent, disciplined application of both rules. That's the key. Ignore rule #1, and a few big losses wipe out many small wins. Ignore rule #2, and your wins might not be big enough to cover your losses.
This is really clarifying things. Okay, you mentioned a practical 5-point checklist, something traders can use before every trade. Based on everything we've discussed, what are those 5 points?
Yeah, this checklist is designed to embed these rules into your actual process, to make you stop and think before you click buy.
Okay, let's hear it. Point number 1.
First, position sizing. Before you trade, consciously decide on your size. Remember the advice. Consider smaller position sizes. Less than 2% of your crypto investment pool should be put into any one coin or token. This directly feeds into rule #1. Small size limits initial risk.
Right, managing risk from the very start. Makes sense. Point 2.
Second, stop loss order. Have you determined your exit point if the trade goes wrong? Think of it as that insurance fee. Where will you cut your losses? This is rule #1 in action. Having that exit plan before you enter is crucial. No hoping allowed.
Third, entry signal confirmation. Why are you getting into this trade right now? Have you clearly identified your specific signal based on your strategy? Is it that 1, 2, 3 pattern, an EN cross, whatever your system uses? Make sure there's a concrete reason, not just FOMO or a gut feeling.
Okay, trade based on your system, not emotion. What's number 4?
Fourth, profit target, initial. Even though rule #2 is about pressing winners, having an initial target is helpful. What price movement would start to prove you correct? It gives you a benchmark for the trade's early performance. You can always adjust it later if the trade really takes off.
That's an initial expectation. Good. And the final point, number 5.
Fifth, add-on plan, if applicable. If your strategy involves scaling in, like we discussed for rule #2, do you know how and when you'll add? What are the specific criteria or price levels for adding to the position if it moves in your favor? Have this planned out beforehand to avoid emotional, impulsive additions. Okay, that's a solid checklist. Position size, stop loss, entry signal, initial target, and add-on plan. Really covers the basis for applying both rules.
Exactly. If you consciously run through those 5 things before every trade, you're actively building the right habits. You're forcing yourself to think about risk and reward potential in a structured way.
So wrapping this up, the core message is pretty clear, isn't it? Mastering these two rules, cut losses short, press winners correctly, and using that pre-trade checklist, that can really shift your trading results.
Absolutely. And it's really worth taking a moment, for self-reflection. Think about how the losing traders approach risk versus the pros. Do you see yourself in either description? Be honest. That awareness is huge.
Yeah, that aha moment you mentioned earlier. And remember, even if you're just trading small amounts like micro trading, applying these principles consistently builds the foundation. Good habits scale.
They really do. Which brings us to maybe the final thought, the provocative question for you, the listener, to consider. Are you actually trading like you expect to be wrong sometimes, with rule #1 firmly in place? And are you truly prepared strategically to capitalize when you are right, using rule #2 effectively?
Yeah, how you answer that, that could really be the difference maker in your whole trading journey. Definitely something to chew on.
Lots to think about. We encourage you to keep exploring, keep refining your approach to risk.
Thank you for joining us on this deep dive. We hope this gave you that shortcut to being better informed and hopefully a more thoughtful trader. Until next time, trade safe.